Welcome to another episode of Boom and Bust. I'm your host, Tony Clement, here at the News Forum where all voices matter. The state of Canada's economy is very much on the minds of all of us, and it's my pleasure to welcome the former governor of the Bank of Canada, Stephen Powell, to Boom and Bust. He currently holds the position of special advisor to Osler Law Firm, and I've agreed that he cannot comment on the Bank of Canada's current decisions and policies. Steve, welcome.
Pleasure to be here, Tony.
So first up, I'd love to get your assessment of how the Canadian economy is performing. These are strange times. We actually had some good news last few days, which indicated that the first quarter results were an increase of economic capacity and volume by 6.5%, which is not too shabby. But I'd love to get your position on this.
Sure. Well, look, the third wave of COVID still needs to play out for us. There's a lot of hardship out there, so we can't minimize that. For the economy, though, wave two was a lot less of an impact than wave one, and I expect wave three will be less still, especially given that vaccinations are spreading quite rapidly now. So, and on top of that, the U.S. fiscal stimulus has boosted global economic growth quite a lot for the estimates for the year. And of course, here in Canada, besides, this is adding to global commodity prices, which is also a good plus for the Canadian economy moving forward. So as of February, it's good to remind ourselves, but as of February, the economy was operating at about 98% where it was pre-COVID. And we know the estimates for March are going to bring us to about 99% of where we were in February of 2020. There'll be some backtracking probably in April and May because, of course, we're doing more rounds of shutdowns. But what is important about this, Tony, is that the economy has demonstrated incredible resilience. I think this is partly is because where we started. We started in the best economic situation we've been in around 40 years. Unemployment was a 40-year low and inflation right on target. There's no better place to be when a big shock is going to come. But also the shutdowns have been very sector specific, not widespread, not contagious. Government policies, of course, were very rapid to respond. And the banks gave mortgage holidays. That was a really important thing that cushioned the blow. So I'm expecting the spread of vaccinations to give us a widespread and sustained recovery, not a boom, because I think people and firms will keep some dry powder after this. But really, COVID is much more like a natural disaster than a typical recession. I'm reminded of after 9/11, you probably remember this. After 9/11, the economists said that people would never travel again and there will be a long global recession. But in fact, we had a boom after 9/11. And I'm also reminded after the Spanish flu, that's 100 years ago now, economists were predicting a depression. Instead, we had the roaring 20s. Well, I'm not expecting the roaring 20s again, but I am in a pretty positive place as we move forward.
That's very interesting. So I'd love to get your perspective then on what you see as the strengths and weaknesses with respect to and maybe even the threats to the Canadian economy going forward.
Well, it does look as though COVID will have some permanent negative effects on the economy. Some of them have silver linings potentially, but as I said at the beginning, it's proving to be really difficult for individuals directly impacted by the shutdowns, whether as workers or as small business owners. In-person retail and bars and restaurants and gyms and anything in the cultural space, movie theaters, all those things. But if we look at what's going on in the workplace, for sure, we're seeing new flexibility in work arrangements, having tested it very rigorously. I think both firms and individuals see the advantages to some degree. So I think even if people end up going to their work half as often, some people will go to work every day, of course. Some may not go at all anymore. There's really a big change. So let's say, give or take, half as often on average, there's going to be less commuting. There's more preference for suburbia. These are having long-lasting effects. It's going to affect commercial real estate, especially downtown. It's going to affect in-person shopping, again, especially downtown. Small business in downtown cores, the little food courts and so on will have half as many people on any given day. So that's going to be tough. And I guess there'll be less business travel than before. That's another place where I think we'll see the effects on airlines.
Welcome back to Boom and Bust. I'm your host, Tony Clement, here with the former governor of the Bank of Canada, Stephen Powell, who now is special advisor to Osler Law Firm. Stephen, I had to cut you off there for the break, but you were just getting into some of the upsides that you see. Very important discussion, I'm sure, for our viewers, so please continue.
Sure. Well, I think most of the upsides, the most notable ones, are in the technology sector, which is no surprise. And the stock market's been flashing that for us for the whole past year. But there will be a lot more investment in technology. So it's not just us switching how we do things, but the investment behind that. And I think companies, for instance, in manufacturing, even in the food sector, will need to space their employees more than they did before. They'll put instead technology in between, and that of course means that efficiency will go up. And I think there'll be higher productivity because of that friendlier kind of you have a role to play in choosing what your work arrangements are. I think that's going to be a higher productivity outcome. Mm-hmm. But I just remind you that IT services was already the hottest sector in the economy before COVID came along. This is only going to boost that. It was the fastest job growth category. It was the fastest category of export growth, IT services. It was already something like 8% of the economy, like bigger than many of the big sectors that you could mention, and growing much faster, like around 8 or 9% per year. So this is only going to accelerate. And so there's no question that that's where we're going to see the really strong performance. We, of course, have seen good performance in the financial sector. We've seen actually job growth over the past year in finance, insurance, real estate, those kinds of sectors, and we've seen a great growth in the agri-food sector. Right. We're seeing in the timber, the forestry sector, we're seeing good growth. So there's lots of bright spots, truthfully, and of course there are when 99% of the economy is more or less on track.
Indeed, indeed. Well, amidst all of that, we had our first federal budget in 2 years. What did you take away from that? What did you think about their spending priorities? There was that debate over whether there was too much stimulus given the circumstances. What's your analysis on that?
Well, it's a very ambitious package, of course. It's more than 700 pages, and it's chock-a-block with initiatives. And as you know well, the government added further spending over the next 3 years of about $100 billion. About a third of that was really just COVID policies. So say in the 70 zone for new initiatives. I think the good news there was that the economy had proved to be a lot stronger than previously expected. So tax revenues have been stronger. And so all that extra spending was able to fit into that budget without actually at a lower level of indebtedness than was predicted back in the fall statement. So there's still a lot of debt, of course. The ratio of debt to national income now is expected to peak at just over 50%. It was 55% in the fall statement. So this is what I mean. It's a little tighter. And but remember, before COVID, we were at 30%. So the COVID and the new initiatives means spending 20% of national income on this one-time basis. From a macroeconomic standpoint, a lot of people are talking about how it points to big government. I kind of disagree with that, Tony. Budgetary revenues were 15% of national income before, and that's still the plan going forward. Expenses, 14% of national income before, 15% after. So it's not a shift to big government, as some people have conveyed it. But of course, it's a big increase in debt. Because of low interest rates, it comes across as affordable. The point here is whether the debt to income ratio, which is projected to decline, it's going to decline under these parameters, but whether it's fast enough to get us ready for another crisis someday is kind of a political question, not for me to say.
And are you concerned about personal debt levels at all amongst consumers?
Well, you know me, Tony, I'm always concerned about personal debt levels, but But the fact is that over the past year, actually, indebtedness has gone down overall. This, of course, because people had very few places to spend their money. Savings rates went up tremendously during the peak parts of the pandemic. Now, we do have a very hot housing market at the same time as we've emerged. And so that, of course, means that those parameters are going to show growth again. And so, but I'm confident that we've got a solid underwriting system, that the banks know what they're doing, and that in general, so do individuals. So I worry less about that, frankly.
We're going to return with our discussion with Stephen Powell, former governor of the Bank of Canada, after this break. Stay with us. And welcome back to Boom and Bust. I'm, as always, your host, Tony Clement, here at the News Forum. We're here with Steve Poloz, the former governor of the Bank of Canada, and he now has a position as special advisor to Osler Law Firm. Steve, you talked about debt levels not being an issue. So are you fairly sanguine about future inflation, those kinds of issues, and the impact on future tax rates?
Well, look, inflation risk is always something we need to take seriously. The economy does have some issues, as we've discussed, but it's not weak in the normal sense of the word that we normally associate with recessions. As I said, the weakness is contained to directly affected sectors, and they seem to pick up again as soon as we take the restrictions off. It's not a generalized weakness. And so that means that there's really not much of a drag on inflation, the way it looks to me. At the same time, commodity prices have taken off. These are key ingredients throughout the economy that, of course, can lead to higher consumer prices down the road. Mind you, commodity prices are rarely a source of ongoing inflation. I mean, can you imagine oil prices going up $20 every year for a long time? Like, probably not without a supply response that would cause the prices to retreat again. And it's the same for most commodities. So the inflation issue, though, is, I'd say, asymmetric right now. You'd want the economy to run pretty hot. The reason you want that is to minimize the permanent losses, the scarring effects of the COVID shock. The longer it takes to get back to normal, the more scarring there will be in the economy, and the more activity would be lost permanently. So getting it going faster, like that's a good move, both in the U.S. and in Canada, where you got fiscal policy layered on top of monetary policy to speed things up. That does mean there's more upside risk on inflation, but the central banks know what they're doing, and I think managing inflation on the upside is a lot easier than managing it on the downside.
What do you take out of the capital markets these days? How are they functioning? What are they telling us?
Well, I'd say, Tony, stock markets got it right from the beginning. I mean, of course, they fell on when COVID broke out globally. But when the policies came together so quickly, stocks recovered almost right away. And even though economies were measured to be weak, I maintain that they weren't really as weak as they looked. And so people talk about a disconnect between the economy and the stock market, and I never really saw one. Markets are forward looking, and they decided we were going to get across the ditch. But in terms of bond market, I mean, the bond markets went price for depression almost right away. Of course, they're anchored by really low central bank rates, but longer yields have really come down a lot. And I mean, that to me was an accident waiting to happen. And so, sure enough, when bond yields started to rise, I think it's just a matter of the bond market catching on to the normalization story. Certainly, it's not an inflation story, I would say, not at levels of 1.6 or 1.7 on 10-year yields. That's still a really low rate. It's normalization, not inflation risk. And all this suggests to me that bond yields still have some upside risk as the recovery unfolds. But there's downside risk too, right? We could have a major fourth wave, or an emerging market crisis in a place like Brazil or India could happen that would give us a whole new downturn in the global economy. So it's hard to say where we're going.
Indeed. And we've got just under a minute before the next break, but you're taking some solace from the policies of President Biden for Canada. Is that right?
Oh, there's no question that those spillovers will be positive ones, and I think there's some important parallels there that I think many firms will see as a bit of a leveler, because the last few years, the uncertainty about tax rates, our tax rates above their tax rates, and uncertainty about the climate policies, that we seem to be ahead of them. This is a bit of a leveling process that I think is probably positive for investment here in Canada.
Well, we're going to continue with our conversation with Steve Pelos, the former governor of the Bank of Canada, after the break. Please stay with us. Welcome back to Boom and Bust. I'm your host, Tony Clement, here at the News Forum. We're continuing our discussion with Stephen Powell, the former governor of the Bank of Canada. He is now special advisor to Osler Law Firm. Steve, can I just drill down a little bit more about U.S. policy, because it has such a huge impact on Canadian economic policy, political policy, you name it. So obviously a new president in charge, President Biden, still talking about Buy American a lot. Are you worried about those kinds of trade restrictions for Canada's rebound?
Well, I always worry about trade restrictions, Tony. I think you know that from a long time ago, and I think there's a presumption in the background, excuse me, that the lifestyles and the things that we take for granted today would be untouched by policies like that, and I don't think it's true at all. But the propensity to do this runs pretty deep. I think it comes from rising income inequality, which makes people uneasy, insecure. And one of the solutions that politicians see is to try to protect them from the stresses of international trade. It often backfires, unfortunately. So I worry about it, but my hope is that the degree of specialization Canada-U.S. is such that in the end we'll negotiate our way through that, and the companies will still be able to manage with it. That's what's happened in the past. But I have no real forecast around that. What I think is more important, really, for the time being, is that the level of uncertainty was so high during the Trump administration that a lot of businesses were putting investment plans on the shelf, just waiting it out. I mean, the period while we were waiting for NAFTA to be torn up and renegotiated and so on, I think just having a lower level of uncertainty as a baseline is going to make things a lot more positive, and I think it's going to bring a lot of investments that were deferred back onto the table as soon as we get out into the broad daylight after COVID is behind us. That's one of the sources of optimism that I think is important.
Now, I'd be remiss, since I've got you here, if we didn't talk about the world economic realignment given China's policies, supply chain policies, political policies, the Belt and Road Initiative. There's a whole series of things that the Chinese government is pursuing. I'd love to get your thoughts on that.
Well, this is a pretty substantial thing. If you think about what we're used to seeing over the past 20 years, was really dominated by the entry of China into the global trading system, and the rest of the world being able to tap in to their workforce. The fact that you can buy a television for $500, that's a gigantic television, as opposed to, the TV I bought in 1978 that was made by Electrohome and Kitchener would be over $2,000 today. That's those kinds of things come from that globalization that we talk about. And so it is a concern that we will not perhaps have that globalization tailwind for us, boosting incomes as well as holding back inflation. That was an important factor for the past 20 years or more. So even if we don't deglobalize, putting in restrictions, as you asked a moment ago, if we just stop globalizing, I think we're going to really notice this as, first of all, a source of firmer pricing, potentially inflation, but probably less disinflation than before. And of course, it's going to slow income growth that we used to get from tapping into global markets. So one alternative to this, of course, there's got to be some sort of realignment. That's a political issue. But of course, we can grow our trade with other countries. We have trade agreements, more trade agreements than any other major country. We can exploit those more, and we haven't tapped them as well as we should have in the past. And I think that's one place that we should really be focusing some of our energy.
Stephen Pelos, it's been an honor and a pleasure to have you on Boom and Bust. Thank you for your insights, and we'd love to have you back at some point. It's great to have you on.
Well, it's a pleasure. Thanks very much. Good to see you.
Thank you. Very interesting perspective from Steve Poloz, the former governor of the Bank of Canada, now special advisor to Osler law firm. Clearly some issues that the Canadian economy still faces, but overall I'd say he was fairly optimistic. He's seeing the growth that we need to see, and he's not too concerned about debt levels at this particular juncture. Thanks for joining us. It was an interesting program.